let's start then with our panel. And I would like to welcome Alex from Accel, Christian from CORDET, Sophie from Eurazeo, and also Rosa from Macquarie. Could you please introduce yourselves in that same order, if possible, to our audience and explain them what your role is within your company and what you're doing?
Hi, my name is Alex Estevez. I'm a venture partner with Accel. Before I dive in, well, good afternoon to everybody in Luxembourg and throughout Europe. Good afternoon in Luxembourg. Good morning from the United States. It was about this time last year when I had the good fortune of attending a conference in Luxembourg with many of you last year. And it was during this time that I really fell for the beauty and potential of Luxembourg. I remember walking through the old city and really being struck by history that many of us in America can't appreciate, and yet it felt new. It felt like the best days might just be ahead. So, but more importantly, I was struck by how welcoming everybody was, and what a wonderful culture, diverse, embracing, open, and so I lament that I can't be with you there today. But I share fond memories of my visit last year, and I hope to visit with all of you again here soon. I'm with Accel. Accel is a Silicon Valley-based venture capital firm. We've been investing for over 35 years, over 300 investments, 125 IPOs, and one of the top venture capital firms of Silicon Valley. And so I've been focused on investing in security and SaaS-related companies as a venture partner here in the United States.
Thanks a lot, Alex. And you're more than welcome to come back to Luxembourg.
I will be there.
Christian?
Okay. Hi, everyone. My name is Christian Ovesen. I'm an investment professional and partner at CORDET Capital Partners, LLP, based out of our London office. CORDET, we are an alternative credit specialist. We're focused on direct lending to smaller mid-market companies across Northern Europe, so specifically seeking to deploy 5 to 30 million euros per investment to businesses that generate between 2 and 15 million euros of EBITDA, specifically then in the UK, in the Nordics, and in the German-speaking parts of Europe and the Benelux region. I'm an investment professional focused on our activities in the German-speaking parts of Europe and the Nordics, and then within the partner group also on fundraising. I have been with the business since we started in 2013 and have a background within leverage finance and special situations financing. I have been financing these types of businesses since 2005. Most recently, prior to CORDET, I was at Credit Suisse. I'm a Danish national. That's briefly me.
Thank you, Christian. What about you, Sophie?
Hi, everyone. So my name is Sophie. I'm with Eurazeo. I'm actually replacing Sophie Flack, who couldn't make it to this panel today and apologizes for it. So Eurazeo is a global private equity firm. We do buyout investments, and we have also extended our scope of activities to other asset classes through the acquisition of Idinvest. So those asset classes include venture and growth capital, private debt, and management of funds. And within Eurazeo in particular, my role is to support the business development of our portfolio companies, including on sustainability issues, which I believe will be a point of discussion today.
Thank you, Sophie.
I think maybe there's maybe 4 or 5 key success factors to overcome this crisis in terms of asset management. First thing was portfolio diversification. I think obviously if as a portfolio manager, you were concentrated on specific sectors that were strongly impacted by the crisis, like tourism, travel, or retailing, brick and mortar. Of course, your portfolio had been more impacted than digital businesses, for example, or healthcare businesses. Another thing was cash management, of course, particularly for companies that could be, short on cash. The capacity to rely on their investors for more funding was critical in overcoming this crisis when no revenue could get in the boutique. Another success factor, I guess, is the robustness of supply chains. Of course, with all the borders that were out of order, if you were able to, bring together all your supply chain, if you had suppliers that were really close to you and that were also robust enough to overcome the crisis on their own, you could overcome this kind of domino effect throughout the supply chain. And last thing maybe, but most important probably, is the human factor. I think as far as employees and clients were engaged, this was probably a key success factor, to have the capacity to rely on the staff, however the business sector was, but to be able to rely on people that were engaged, and also to demonstrate the resilience of the entrepreneurs in this crisis was key in fund management.
Thank you, Sophie.
I would break it from our perspective into a portfolio company perspective and then an investor perspective. With our portfolio companies, this was a striking time early in the year when many of our CEOs hadn't really been through crises like this, 2000, 2008. And so on average, you saw growth projections contract and free cash flow burn actually contract as companies cut their expenses. But then we realized, our companies began to realize that this was actually very different from 2000 and 2008 in terms of the cloud software infrastructure, where while on the one hand, you ran the risk of getting over your skis and having a fall, but on the other hand, great opportunity presented itself. And so you look at companies like Hopin, this conference, that was, it turned out to be an exciting year for Hopin. Companies like Miro, originally based in the Ukraine, around team collaboration. And so the year presented uncommon opportunity for certain companies. If you look at Zoom, which we're also on, I think they added $150 billion of market cap over the course of the year, or Shopify $80 billion as more companies migrated to e-commerce. So it's been a very unusual year in the sense that it was both uncommonly crisis oriented, like one we had never seen, but also one with a unusual silver lining in terms of opportunity. As potential investors, it also changed the landscape dramatically, because the venture investing community is much more, it's a higher risk. It's much more interpersonal. Sometimes you're not even betting on due diligence. You're betting on a person because there's no due diligence to do. It's a new company. And so that is a very bespoke, curated process, and to lose that personal interface was daunting to people who had been in the industry for a long period of time. But the industry has adapted, and more and more you're seeing investments that are being done at scale without any personal interface. That will present risk further down the road in terms of missed opportunities or missed risks from the lack of personal interface. But the industry adapted pretty quickly in terms of the ability to find opportunities to invest and to invest in an environment that was virtual.
Very briefly, in terms of how we have coped, I think we, as everyone else, had a portfolio going in to the crisis. We were fortunate that we hadn't invested in, or we were obviously credit funds or lent money to restaurants and airlines and other sort of associated industries. We didn't think that was such a good idea anyway. And so for us, first and foremost, was to create a COVID analysis system in order to measure and track the influence of the crisis on those particular borrowing companies. In crises like this, it's always about liquidity. So making sure that we know which companies are likely to run out of cash and when. And then so therefore quickly being able to ascertain which portfolio companies we need to be concerned about. And then an upcoming the conversation with private equity sponsors on those particular names. Overall, we are supportive of the businesses that we have financed. But of course, if you cannot measure, it's very difficult to manage it. So having a key set of KPIs is absolutely important. And we will continue to do that going forward, irrespective of whether or not the new vaccines will work, etc.
Sure, completely makes sense. Let's now move on to the second question. If you want, we can stick with you directly, Christian. So if we're now looking forward and not backwards anymore, any new concrete trends crystallizing, which could be also then the ingredients of your next success stories?
I think there's a few trends. The pandemic, I think, has accelerated a number of things. Number one, working from home. Number two, increased use of technology. Number three, ESG. And then I think number four, we're obviously a credit investor. The likelihood that interest rates will remain low for the foreseeable future. I think all governments and issuance of bonds will have an incentive to keep those rates as low in order to actually pay for all of this stimulus that has taken place. And in that context, for us, we have, I think, increased our focus on ESG. We were already pretty environmentally focused before. We have been, as an example, ourselves using Zoom for about 4 years. And consequently for us as a company, transitioning to Zoom and technology and working from home, we were already doing that beforehand. But certainly in the post-COVID world, investing in areas that ensures that this will continue is paramount. So we think that these trends will accelerate, and therefore areas that were difficult for us beforehand are probably not going to be any easier. We'll probably continue to do more of the same.
Any key ingredients for the other panelists?
We've mentioned a lot about technology here as future trends. It's hard not to. And at Accel, that's been our focus primarily, especially on cloud and SaaS. And when we consider the opportunities that we think might be impactful to reaching that top decile, that top quartile in 10 years, there are five that really we get motivated by. One is that work coming to home. Hopin is a good example today, where we're working in effect from home. Many of us are, at least, and that's kind of become a new accepted norm. Second is telemedicine, where more and more doctors are online, and that has the opportunity to really transform a very large part of our broader economy in good ways. We're seeing the emergence not just of this hyper-automation that comes from companies like UiPath with robotic process automation, but also the low-code, no-code environment that is empowering non-technical, non-development employees to not just digitize their environment further, but also to automate those processes around them in ways that they couldn't do before. And so that really has a potential to dramatically transform the enterprise. We see that as a 10-year cycle that's just at the beginning. FinTech is finally moved to the cloud. The emergence of digital currency, we believe, is still at its early stages. We've been involved with this with Braintree and Venmo and other companies over the years, but we're excited about the opportunity ahead in terms of the digitization of the fintech stack. And then in the midst of all of this convergence of digital adoption at the home, with your health, with your enterprise, with your financials, there is ripe opportunity for corruption and for fraud. And so the cyber criminals are feasting right now. And there's great opportunity around privacy and around security that helps ensure that this transition to the digital world is done in a safe and effective way.
Safe and sound as it should be. Sophie?
Yeah, I fully agree with everything that's been said. I think probably the good side of this crisis was probably to be a trigger for acceleration in a positive way, acceleration towards more digitalization of traditional businesses, and also acceleration towards reaching the goals set forth by the Paris Agreement for climate. And I think there are tremendous money pouring in the economy worldwide to support the economy and to avoid an economic and social crisis after this sanitary crisis. And all this money pouring in is an opportunity to be channeled towards such societal good, climate, and digitization.
You're all experts, part of renowned and strong companies. Where do you see your specific added value? Which strategic approach or touch will allow you to create further superior vintages over the next decades to come? Now we are becoming a little bit more personal. What can you tell us about that? Who wants to start?
Yeah, we invest according to a set of trends, and we will continue to do that. And some of those have not been changed with COVID, but so were the same before. So specifically, urbanization, immigration, and climate change, and being at the, should we say, the right side of history on technological developments. So all of our portfolio companies that we've selected prior to COVID, we felt that the time of investment were on the right side of history in those trends, and we will continue to do that going forward. I think the development within it probably is that we're obviously just a lender. We're not an owner of assets, but we will, as part of our ESG focus, we can't influence the businesses per se, but what we can do is not lend. So I think what will happen is that at least lenders such as us will likely take a sort of a stance, and perhaps not just we just won't finance polluting businesses, and that will result in the capital markets then perhaps will create a premium for carbonization. I don't know. I'm purely speculating here, but at least from our perspective, businesses need to meet our sort of selection criteria, and they will continue to evolve during the post-COVID world.
The venture landscape has become increasingly competitive. I think just this year to date, there have been, I think, about $10 billion invested in private cloud companies in both Europe and Israel. I think the number is 20 billion year to date, at least now in the US. And so there's a copious amount of venture capital available. And so the source of differentiation isn't really the finding or the valuation or any financial trickery, if you will. It's really around how do you help ensure that the potential of these companies are realized. Accel is always focused on investing in great teams and identifying great entrepreneurs. And so when you look at the family of entrepreneurs in Accel, it's really a remarkable gathering of great leaders. And I think Rosa referenced earlier how important it is to get that right. And so increasingly we help differentiate by sharing through community efforts. How do you achieve? How do you build? How do you scale? How do you do it? And then we invest a lot in human resources in terms of actually helping to source teams and helping to build teams that again can help these entrepreneurs realize their potential. So the capital is increasingly competitive in the venture landscape, and valuations multiples are at near historic highs. And so the opportunity for us to differentiate is really on helping to ensure that potential is realized through building great teams.
Yes, the financial partners are not financial partners only anymore. What entrepreneurs expect us to do is to provide more than just money. Of course, money was critical when companies were running out of cash during the crisis, but they are expecting us to provide more than that and to help them grow, scale internationally, to help them share among peers best practices and to accelerate, basically, to be more resilient and to have this competitive edge that will allow them to recruit the best talents everywhere, especially on skills that are very tense. And all those support, all this support is critical in creating additional value compared to others. And more funds now put forward these kind of additional services and start themselves to provide these additional services to the portfolio companies.
Any specific obstacles you have identified and which could spoil the party and also the performance of the future funds? What can you share with us on that specific question?
Well, to me, I think, when talking about the next 10 years, I think what is really critical as a risk is climate change. When we look back 10 years ago was the subprime crisis. People were stunned and talking about a black swan kind of probabilistic event. But 10 years later, we have this COVID-19 crisis, again, an extreme risk that maybe very few people anticipated. And so we have to acknowledge that extreme risk is not that extreme anymore. And climate risk is not not extreme in terms of probability. And climate risk is an extreme risk in terms of impact, but is a reality in terms of occurrence. And we will see we will have to bear the impacts over the next years, up to 10, 20, 50 years. If we don't act now, it will be a major impact on our economies, on our societies, and of course on financial performance. So I think a cloud that is rising is not just a cloud, it's just this massive atmosphere that is loaded with carbon and that we have to address now. With Eurazeo, we've committed to carbon neutrality. We are submitting a science-based target reduction to fit into a well below 2 degrees trajectory by 2040. So we want to be net zero by 2040, and of course we will do that on our scope as a portfolio management company, but also we will engage our portfolio companies to fit into this same trajectory and to reduce as much as possible their emissions, so that collectively we can work towards making an impact on climate. This is really, really ambitious because as financial investors, we finance growth companies, right? Sometimes hyper growth companies, as far as venture is concerned, for example. So we have to find this equilibrium between financing growth, but at the same time making sure that this growth does not generate proportionally amounts of carbon in the atmosphere. And this is, there's no clear solution to it, but I think it's really something that we all should start addressing now if we don't want to be stuck in an even worse crisis in 10 years from now.
Well noted. Other perspectives on the obstacles?
I think, yeah, I agree on the climate point and the risk that carbon and the environment as a whole has been mispriced, or the risk of that has been mispriced recently. But to add to that, globalization has been a feature of most of our lives in the last decade, if not longer. And we believe that perhaps that the next 10 years will become increasingly, should we say, localized. And that goes hand in hand with increased levels of automation in our wider economy. And that will also need to be taken into account of how of investment thesis is going forward. So sort of going along globalization may have been a good place to be in the last 10 years. I'm not sure it will be in the next 10 years. And in the short term, I think in the event that these vaccines are not successful and there will be third or fourth or fifth lockdowns, then I think the short-term impact on portfolios could be significant.
If you look at the software landscape, the last 10 years has been characterized first by what we call the rise of the giants, where in 2010, there were 3 companies with market cap each over $100 billion. And in 2020, there are now 8. And that's $2.7 trillion in market cap. It's an extraordinary shift of power. And in a sense, that was good in that it demonstrated broad addressable markets, and the next generation of has also grown, but from 8 companies over $1 billion in market cap to now 75 listed companies over $1 billion in market cap. That stated, I think it's probably prudent to question how sustainable this trend is, and whether this shift in power that's aggregated with cloud software companies might actually be met with more regulatory and commercial efforts to either manage or control some of that otherwise unleashed power. And so I think that it's been a remarkable prior 10 years, but I think it's probably wise to question how regulatory bodies and broader independent entities might try to manage this continued growth from a public policy perspective.
I can start, and first I would like to highlight the fact that throughout this panel we've actually talked a lot about ESG and sustainability and climate. And probably if we had this panel 2 years ago or so, we wouldn't have talked that much about ESG. And I think this highlights the fact that ESG has become mainstream, and there's a growing congruence between doing ESG investment and doing investment per se. I mean, but a couple of years ago, there was this kind of antagonism between does ESG actually compromise financial performance or not? People were actually asking the question. And I think today this question is obsolete. I think most people agree that ESG does create value, sustainable value, long-term value, robust value, and financial performance. And this also relates to probably different changes in society in general, and the social acceptance of what businesses can or cannot do for society in general. License to operate is critical for businesses, and they now have to sort of abide by what their stakeholders demand them to do. Their consumers, their investors, the whole value chain. And of course, climate is a real topic. Climate, plastic, privacy, inclusion, diversity. I mean, there's been all those, social manifestos regarding diversity and inclusion recently. You know what I'm talking about. And I think, it also touches upon asset classes that maybe we can believe are kind of far away from those topics. But if I want to take an example, for example, if you look at AI, for example, artificial intelligence, people recognize that some algorithms have been trained by people that tell them to apply the same rules, and so they amplify the biases that society has told them to do. And so this is really interesting from an ethical point of view. ESG has moved from compliance to social questions, social matters, and in more general towards sustainable development goals, which is a 2030 agenda for the United Nations.
Any views from our other panelists?
An expression that says in investing, you don't worry about the storm that's coming, you just set your sails. and to adjust to the wind. And so what I'm impressed by is a broad acknowledgement that this is a macro trend in terms of we'll call it regulatory, call it compliance, ESG more specifically. But there's an acknowledgement that this is a trend and that it actually can be a good opportunity from an investment perspective. I think that we share that view. And if you look at investments in the past around solar, like Sunrun or others, that they're good opportunities for investment that transform our society in positive ways. And so that's always been an important thesis for Accel. And so I think that I think there are promising days ahead as that transition continues.
And I think for Christian, you highlighted already a few elements in your previous response to the other question. What you could do then as CORDET?
So in terms of sustainable finance, we look at as a, I think what we call a whole cycle approach. So looking at the sort of the totality of the impact on each investment that we look at on the entire environmental impact and cycle of that particular product or service, and that can get a little bit complicated sometimes, and I think focusing on that going forward will be very important, because it's easy to lend or to invest in things that are pure green, whether it's I don't know, windmills or bioenergy or something that has no emissions. But it gets a little bit harder when you move into the gray zone and where you need to take account of the entire effect on the whole product life cycle. And that will be something that we will focus on going forward.
Great. Thanks again, then, for your transparency and for sharing your position and these ideas. Let's now move on then to the two questions we received. The first one, do you think we can anticipate an increase in deal-making activity in the first half of 2021? And the second one, can we also say that the current crisis provides an array of new investment opportunities? As usual, without crystal ball.
But I think in terms of new investment opportunities, typically this has already been mentioned, but of course, health tech has gained strong momentum through telemedicine in particular, but the full range of health tech in general. Of course, everything that relates to future of work, and Zoom is a great example of this. And also, I think food and ag tech also is gaining great traction. In particular because of a change in consumer mindsets, and also the climate, again, the climate stakes, where the agri-industry in general is a part of the problem, but also a great part of the solution on this topic.
I think from our perspective, you asked if there's a good chance of increasing deals in Q1. Assuming that the vaccines lead to a lower level of lockdown and a more confidence in the economy, there's a large part of our fund that is providing acquisition financing, and therefore, in effect, a derivative of the M&A market. And that market likes forecastability and stability. And an end to the pandemic would obviously provide that. And based on that, there would be a good case for an increase in deal volumes, I think.
You look at the IPOs from 19 to 20, there have been roughly the same number of IPOs in the software space, at 14 year over year, 14 last year, 14 this year, but the average size has doubled. And so that's a reflection of the change in the multiple environment and low cost of capital. Twice as much capital in the private markets combined with the IPO markets has been raised in 20 versus 19. So to speculate that would continue is in some ways capricious, or certainly speculative that it might double again next year. This is an extraordinary year where the low cost of capital combined with the rapid transition to digital environments has wreaked havoc on normal valuation metrics. And so if you look at Europe specifically, I think there was about $7 billion spent on cloud funding, VC cloud funding last year, and about 10 projected for this year. So that's up 30-40%. I think on the one hand, you have some very interesting, credible macro trends and companies executing against those trends that portend to continued success next year, assuming things continue, the macro environment continues as expected. That stated, we're at historic highs in terms of valuation multiples, and I would not expect that to continue to extend. At some point, there's a normalization that happens there. So when you look at a company level perspective, I think there's a lot of promise with a lot of these, especially the digital focused companies, that are helping to transform these societies and economies. But the macro environment of extremely low cost of capital, in response to COVID, eventually is going to normalize, and I think that starts to recalibrate some of these extreme valuation multiples we're seeing.
And also, then the last question: any interesting technology on your radar which could, on one side, correspond to an interesting investment, but also optimize your fund structure?
For us, the first trend we mentioned earlier, the work from home trend, is I'll call it more broadly distributed teams. We're seeing over and over teams that are being, of high potential talent being aggregated in disparate locations because the technology allows it now. There's no replication for being in person. I would love to be there in person right now, but our investment in Hopin is allowing us to have this exchange of good ideas. And so we expect that trend to continue. I think after COVID, the world will be different because we've realized that we actually can be productive in a distributed way. And I don't think that that's going to recalibrate dramatically. I think that represents meaningful opportunities for continued success with companies that facilitate that collaboration, and the ecosystem around that, around security, around privacy, that will also present investment opportunities, we believe, in the future.
Any last comment from our other panelists before we close the panel? If not, then really thanks a lot to Sophie, Rosa, Alex, and also Christian for your insights, for your vision of the next decade. We certainly wish you fantastic future vintages, and stay in touch for more insights from you also in the future. Thanks a lot, and see you soon.
Thank you.
Thank you very much.
Bye.